This is the ultimate tax setup for online entrepreneurs. If you're a location independent entrepreneur, this is the structure for you, the one that you eventually want to get to. Maybe now, not yet, but eventually this is the structure that you want. It covers all bases. Let's get into it. So first off, I always start my videos with this because if you're watching this and you have no idea about the different types of taxes, then it's useless for me to even explain stuff. Sole trader company. If you're a sole trader, you are the business. All the money that you make is taxed personally, okay? When you have a company, the company pays its own taxes on its own profits, and then when the company pays out the directors, whether that's through a salary, whether that's through dividends, then the person, you as the owner, have to pay taxes again, but this time personally, right? So income tax is what you have to pay personally on your income, depends on your tax residency personally. Corporation tax is what the company has to pay on the company's profits, and that rate is given by the tax residency of the company, which most of the times is where the company's set up, right? So if it's a UK company, that's 25%. So when you own a company, this is the structure, right? Ownership, you own 100% of the company. The clients now pay the company in the company's bank account. They don't pay you personally. And now let's say the company makes 100 in profit. The company pays 25% in corporation tax, example, and you're left with 750. Okay. Now that 750 are profits. You own the company, you can take them out. But when you take out that money, you now have to pay taxes again based on where you're a tax resident, right? So example, UK, 39%, right? So company pays 250, and then when you take out money, you pay another 295 person. Okay. Now got that out of the way. If you're a sole trader right now, if you're watching this, you're probably a sole trader. So you are the business. All the money that you're earning is being taxed, or maybe you're not even paying taxes anywhere, but it's supposed to be taxed at 40% plus social contributions. You've got no legal entity, or maybe you're one of those guys with an LLC. So step before, this is how much tax you're paying, or you're supposed to be paying based on the amount of profit that you're making with this structure. Or maybe you're one step ahead. Maybe you do have an LLC. Maybe you got some random guys to set up an LLC on Fiverr, or maybe you've gone with a guy who was advertising 0% tax through the LLC. Maybe you've even gone a step further. Maybe you even got tax residency in a country like Thailand. The main issue here is source income. Okay, so if you have an LLC, you probably know that the LLC doesn't pay any taxes. Now, if you're a bit smarter, you also know that now you are supposed to pay taxes on the profits of the LLC. Okay, so just having an LLC doesn't magically get rid of your tax obligations, but it just passes them on to you, and then you have to pay taxes based on where you're a tax resident of. Now, if you're resident in Thailand, Thailand only taxes you on money you bring inside of Thailand. Okay, so if you keep all your money outside of Thailand, you don't pay any taxes, and that works, right? That's fine. Now, the main issue here is, and this is not enforced yet in Thailand, but when we get to a higher level, reason why we're talking about the ultimate setup, the main issue then becomes source income. So income from the LLC is active, which means is taxed based on where it's generated. Okay, so if you live in Thailand 360 days and you're performing the activities that make the money in Thailand, you're performing the services and you're delivering on your offers in Thailand, it doesn't matter that you're not bringing it in Thailand, because technically it's sourced from Thailand. That's where the income has been generated, and that's where you're supposed to be paying taxes. So this is the main issue, and right now it's not enforced too much, obviously, because you watching, maybe you're making good money, maybe you're making 20, 30, 50k a month, but it's still not enough to trigger that. And especially if you're on a digital nomad visa, Thailand considers that a tourist visa, right? So they don't even look into this stuff. Now, if you're making a lot of money, trust me, they will. So the issue with this is source income. So basically we want to get paid somewhere through somewhere that's passive. Okay, so that's source income more like. So how do we do this? In the ideal scenario, we own a holding company. Obviously we want companies because of the limitation of liability. When you have a company, you can't be sued personally. Your personal assets are protected. If the company goes bankrupt, you can just close it. Now, obviously you can't use your company for personal expenses and expect this to hold. Obviously, if you need to use company for company expenses, right, you need to use company money for company expenses. Otherwise this limitation of liability doesn't hold. But let's assume you're doing everything right and you're being a good boy. We want a holding company, right? A holding company's only job is to hold the shares in another company. Now, the company that's going to be making money is this operating company, and ideally we want this operating company to pay no tax. And when we take money out of this company, we don't want to take it personally all the way up to us. We actually want to pass it on to the holding company, right? And you're like, well, why do we need this extra layer of protection? Well, it's exactly that, a layer of protection, and crucially it separates management from ownership, right? So ownership from control. So now, yes, you control this company, but you don't own it directly, right? So there's this separation where even though you are performing services for this company, you can just take a little salary from this company, and that's your your contribution to the service delivery, and then you can get paid from the holding company. But let's get into a bit more detail. So step one, operating company. Where do we set this up? And obviously a lot of people talk about it. There's a reason why. The LLC is a great company to have, okay? I'm not saying it's wrong to have an LLC, it's just the way most people use it. So set up an operating company. Operating company just means the one that makes the money, right? So you probably connect your payment processes through here. You probably get your bank transfers through here. It does exactly that. We want the company in the States because the States have a good reputation, at least for when it comes to banking and business. It's got good payment processing. A lot of people, even if they go to Dubai, they'll still have an LLC because Stripe with free zone companies can get a bit funny. Payments can get declined, and it has no corporation tax. So this is what people tell you. It's a pass-through entity. The company pays no tax. Now, this doesn't mean that nothing in this structure pays tax, just the company doesn't pay tax, assuming you don't have any operations in the United States, right? You don't physically work from the United States. Now, what no one tells you, again, is that it's the owner of the LLC that is liable for the taxes on the profits of the LLC. So for example, if this holding company wasn't here and you were the owner, which is how, obviously the normal structure would be without this holding company, the owner, so you would be liable for the profits of the company. Now, because there's this shield in the middle, now the holding company is liable for the profits of the LLC. So you are protected. There's a layer of protection. But now the question becomes, okay, well now it's this holding company that's going to pay tax on the profits of the LLC, but where should we put the holding company? And the answer is Hong Kong. Set up a holding company in Hong Kong. Again, we want a holding company because it separates management from ownership. So all income you receive now is passive. Okay, it's not active income anymore, it's passive. So Hong Kong is a great place because it has a strong international reputation. It's a hub for Southeast Asia. It's good to hold money in here. I wouldn't really set up a holding company unless you had quite a bit of money to hold. Obviously, if you make 50k, spend 50k, you can just keep your LLC. But if you need a place where to hoard money and build cash reserves that you later want to reinvest, maybe you want to hire, maybe you want to buy stuff through the company, I suggest you set up a holding, and I suggest you set it up in Hong Kong. Now, Hong Kong actually has a 16.5% corporation tax. It's actually only 8% up to 250k US, and then 16.5 on anything above, but it has territorial taxation. Okay, now here is where we're getting a bit technical. Hong Kong only taxes you on money that you source from within the country. Okay, so again, if you make money within the borders of Hong Kong, then that money's taxed. Now, obviously, we won't be doing that. However, the LLC's income, despite this being a disregarded entity, Hong Kong sees this US LLC as a body corporate anyways. So even though technically money that's passed from an LLC is considered active, the US considers it active because this is a disregarded entity and it's transparent for tax purposes. Hong Kong doesn't care. And they're like, well, we don't care. We just see this LLC as a corporation, right? So we think all distributions from this LLC are just treated as dividends. So they're passive. So this territorial taxation doesn't really apply, okay? So all the profits are passed up, but they're considered dividends. They're not considered active income. Now, does that mean they're taxed at 16.5%? Not necessarily. So the way that they don't get taxed at 16.5% in this situation is by building economic substance. Okay, so there's this thing called foreign source income exemption. So for when passive income comes into Hong Kong, they can be exempt either if there's this thing called participation exemption, but it won't apply because the LLC doesn't have any corporation tax. So just ignore that for a minute. Or if there's economic substance. Now, what does economic substance mean? It means maybe office. It means having board of directors meetings and shareholder meetings, AGMs, and all this stuff. Okay. Now, the tricky thing here is that Hong Kong might still decide to consider the profits active. At the end of the day, it depends on a case-to-case basis, but we want to be protected regardless of how they decide to treat these. If they decide to treat the LLC distributions as active, we want to pay 0% tax thanks to the territorial taxation, right? The offshore exemption. Profits are not sourced from Hong Kong. If they consider it as passive, we want to have enough economic substance to satisfy this foreign sourced income exemption, which means, again, we want to have maybe an office, we want to have board of director meetings, so management is there, but profits are not sourced from there. And again, it gets very complicated, but there's this fine line where regardless of whether these profits are considered active or passive, you have enough substance in Hong Kong so that dividends that are received are still at 0% tax. And if they're considered as active, the profits have not been sourced from Hong Kong, so it's still 0%. It gets complicated, but it's fine. If you want my help setting this up properly, you can book a call using the first link in the description. So that's step number 2. So we have an LLC that pays no taxes, and we have a Hong Kong limited company that pays no taxes. And then the money's parked in this LTD, and then you only take out the money that you want. Now, step 3 is the personal tax, right? And again, ideally, we live in a territorial tax country, so we don't pay tax on dividends. Again, territorial, you're only taxed on income that you source from a country. If you're receiving dividends, which again is passive income from a country that's foreign, abroad, you won't pay tax on that money. Now, if you're a resident of a remittance-based system like Thailand, you'd only pay taxes on the part of those dividends that's brought inside of Thailand. But then again, even if you are in a higher tax country, you don't need to take out all of the money. So where most of you go wrong is that you think of the business and you as the same exact person. You're like, business money is my money. If I want to spend money, I need to take it out and I need to spend it. Now, obviously, if you live in a 0% tax country, then cool, you can do that. But what if you decide to relocate to a higher tax country? Then that's an issue. And tax planning goes back to the company level and not to the personal level anymore. Okay, now obviously be careful of management and control rules. Obviously, we want to have substance in Hong Kong, so it should be fine. But obviously, remember, you can't just live in, Italy, set up a company in Dubai and just do that. You need substance in the UAE, you need substance in Hong Kong. But I'll give you an example if you were to relocate to a high tax country such as Italy, for example, in Europe. Okay, so this is step 4, and you can still have this structure here with an LLC with a Hong Kong limited company, and you live in Italy, obviously assuming we have substance in Hong Kong. We want to be careful not to fall into central management and control, CFC rules, like we don't want any of that, right? But if we are doing everything properly, when we want to reinvest stuff or buy stuff, we don't need to take out this money because they're taxed at 26%. We can keep the money within this circle, so all the money stays in this group. So LLC 0%, Hong Kong 0%. When it's passed down, it pays no taxes. You can invest into real estate, other ventures through the Lux company. So imagine if you had invested in your personal name, then you would have had to pay 26% on all these profits. Whereas if you just keep it within the circle, you wouldn't have to pay the 26% profit as it stays within the group. So same example, and again, here we're just having a bit of fun. But just to give you an idea, let's say we want to buy a villa in Samui. We'll open a company in Thailand to buy it, right? Let's say you want to invest into a startup in Southeast Asia, we'll open a company in Singapore to invest. Let's say you want to buy land in South America, we can open a company in Panama, right? But they'll all be underneath this Hong Kong company. And funnily enough, they can all be financed by the profits of this US LLC. And do you have to pay taxes personally just because you live in Italy, just because you live in the UK, in Finland, wherever you live, right? No, because they all stay within this green circle. You don't need to take money out personally that you don't need. And again, you'll learn this because at the end of the day, you'll find out you don't really need more than 5 to 10K a month to live properly. And that's a lot of money, like 10K a month to live on. We're not talking business expense. We're not talking business trips. We're just talking personally, how much do you actually need to live personally. So when you think about it, and when you structure this way, when you're making a lot of money, your personal tax residency doesn't really matter because all the money stays within this group, and that's how you invest. You invest through companies. Just to go back to this, because obviously here, you're probably not here yet, but you might be here. You might have a US LLC and you might be in Thailand, but you might be messing up a couple of things. You might be using your company money for personal expenses. You might not be filing a tax return in home country, so you need to be careful. So this is the ultimate setup. We have a US LLC, great payment processing, banking solutions, and international clients, and we can get paid a nominal salary. So like 2K a month. We can pay taxes on that. We can pay taxes on 2K a month, right? It doesn't matter. Now, we have a Hong Kong limited company as a holding, again, to separate ownership from control. We lower the risk of permanent establishment because now we're just an employee of this LLC. We don't own it. And most of the income we take out passively as dividends. And then we have tax residency in a territorial remittance tax country. So all the dividends that we take out are tax-free, obviously assuming we don't bring them into a remittance tax country. If we live into a territorial tax country, cool, no tax at all. If we live into a remittance tax country, we only pay tax on what we bring in Thailand. But realistically, we're going to be fine living on this 2K a month, right? In Thailand, very likely, maybe you need 3, you can adjust the salary as needed. But all the dividends that you take out personally, you shouldn't need to pay tax on. So this is the ultimate setup. If you have any questions about this, you can drop a comment or DM me on Instagram. And if you want my help to set up this structure for you, or just want to have a chat with me, you can book a call using the first link in the description. And yeah, hope this was valuable, and thanks for watching. Bye bye.